Joanne, let me start with you. I'm not sure it's fair to ask what the markets made of this week because they were all over the place. There was so much noise in the marketplace. But what did you take away from the week?
Well, David, I think clearly the market is coming to terms with the higher risk of recession, with the reality of higher interest rates for a bit longer than perhaps they had expected. And that's doing a couple things. Higher uncertainty means stock valuations have to come down with that higher risk premium. And with higher interest rates, on the coming now and on the horizon for a bit longer than expected, that also takes valuations down. So we saw in the price action a clear move towards safety. Consumer staples outperform, healthcare outperform, and banks, are a mixed bag because they're benefiting from those higher rates while at the same time they could face headwinds from a recession.
So, Bob, you're Mr. Banking. What did the banks make out of this?
So I think the banks have a very, very interesting period ahead. On the positive side, David, as Joanne said, higher interest rates in this kind of an environment, steeper curves, more volatility, higher rates across the board are good for banks. They're good for their margins and lending. They're good for a host of things, their repo books. But the thing that'll be most positive, I think, when we see the earnings is it's an incredible trading environment. Those banks, particularly the U.S. banks that maintained a trading platform, are going to have a really, really strong quarter. On the more balanced side, I'd say that unquestionably we have a serious commitment to investing in our opportunistic credit fund. We're seeing real cracks in the lower end of credit. And I think the banks are going to face not just, a weaker economy, but one of the aspects of that will be higher provisions in their credit books. And that comes after a couple of years of either modest or credit write-backs. So on the positive side, rates will be good. Trading is going to be extraordinary. On the more balanced side, mortgages down quite a bit, writing of mortgages and credit provisions.
So, Bob, the markets did a lot of adjusting this week, a lot of capital reallocation, I think it's fair to say. Did they do enough? You heard Larry Summers there in the open saying he thinks the markets still don't understand how much pain we have in front of us. Do you agree with that, Bob?
Yes and no. I mean, I think you have to give some credit. We've talked about this since last December. The Fed waited clearly too long. They eased with zero interest rates and $120 billion in U.S. Treasury and mortgage security purchases into an economy that had already recovered, had tight labor, had higher prices and higher inflation. So we're paying that price now. But having said that, I thought that the chairman was correct and the Fed was correct to raise 75 basis points this week. We are starting to see the early signs of economic downturn in manufacturing and consumer sales. Very, very early days. So I don't think this is adequate. But I do want to give some credit for the recognition that they have to move more quickly. My worry, though, David and Joanne, I'd love your perspective on this. My worry is that in other cycles, we've seen the Fed tighten when the economy is doing really well. As they continue to tighten here, which they need to do, they'll be doing it into an economy that's beginning to slow. And I worry that could be more impactful in terms of the slowing of the economy.
So, Joanne, what about on the equity side? There's been a lot of devaluation, if I can put it that way, a lot of cheaper equities today than there was a month ago. Is it time to start buying equities again?
Well, yeah, David, clearly we are in a slowing environment, as Bob just pointed out. But what people forget is that earnings are nominal. This inflation that we're seeing is showing up in companies' sales figures. It's showing up in their earnings figures. And that's why earnings expectations keep ratcheting higher, even as valuations come down. And what we're seeing is a lot of good company stocks being thrown out, being pummeled along with weaker company stocks. And that does create opportunities for investors to go sort of quality hunting, particularly if you're a GARP investor, a growth at a reasonable price. There's a lot of good companies out there that have become very attractive here. And investors really need to focus not on what's going to happen for 6 months or even 12 months. If you're in the equity market, you better be there for multiple years. And this right now does create a really good opportunity to enhance your portfolio and build for beyond the current crisis.
Bob, it strikes me that one of the things we heard this day out of President Biden, this week, I'm sorry, out of President Biden, as well as out of Fed Chair Jay Powell, is we're not in this alone. When it comes to inflation, and by the way, tightening in a lot of places, it's more of a global phenomenon. You have a lot of experience with investing around the globe. What does this tell you in terms of investing around the globe?
Well, I think number one, when you look to Europe, it's at times like this that, it gives us great confidence here in the U.S. that, the depth and quality of the capital markets are second to none in the world. And as Joanne said, as you go through a period where it's kind of risk off, so everything is declining. And we had exuberance in not just stocks, we had exuberance in house prices, we had exuberance in Bitcoin, and everything is kind of risk off. Thank goodness that we have this incredible capital market in the U.S. And you compare and contrast that to the challenges in Europe, with 26 odd countries, without a banking union, with less flexibility around fiscal integration, less flexibility around monetary policy, and nowhere near the depth and quality of the capital markets. I think the challenges that we face are going to be faced in greater sense across Europe.
Bob, fair enough, very deep capital markets, but we saw some real problems with liquidity toward the beginning of the year, particularly in the 2-year Treasury. Are we concerned at all that the markets might actually break?
I don't see that as a concern at all. No, and I think again, you look to the diversification depth. So much of what's here in the U.S. in terms of the capital markets is a huge advantage, and to worry about the depth of the U.S. Treasury market around the 2-year is just not something that should be on our list.
And you can see that from the strength of the dollar as well,
yeah.
Right? I mean, there's a reason why investors are still flocking to treasuries. And it's because, we're still a safe haven. There's still more confidence in the U.S. government's ability to pay its debts than, almost any other. And Europe, by the way, obviously is facing greater headwinds than the U.S. is. So if you're going to compare stock market opportunities, given the war in Ukraine and the sanctions and the energy problems, makes the U.S. look far more attractive.
Well, Joanne, I'm glad you took us to FX, because that's a question. Can the dollar continue to strengthen against the other currencies like that? We saw the Swiss National Bank, for example, surprise everyone, at least surprise me, on raising rates, and we may have the ECB close behind. Is there going to be sort of a currency tension there?
Yeah, that's going to be really hard to predict. I think it just depends on the pace of the tightening in the multiple countries, right, to determine those relative prices of currencies. And right, what we're seeing is this global inflation problem is really born of all of these shortages that started in the pandemic, that extended to OPEC's constraints on supply, and then, of course, from the war. And so, we're all trying to get inflation under control. And that the currency movements, I think, are really just signifying how important the dollar is and U.S. Treasuries are as a safe haven in this kind of an environment.
Bob,
just to feed on that, it's both the technicals, which is the depth of the capital markets and the liquidity of the dollar, and what's the alternative, as well as the fundamentals in terms of how the Fed is behaving and whatnot. So it's really both the technicals and the fundamentals, Joanne, that I think are favoring the dollar right now.